The market has a talent for hijacking your nervous system. A green day makes you feel smart. A red day makes you feel threatened. A new high makes you feel late. A sell-off makes you feel stupid. And in that emotional storm, people don't make investment decisions. They make identity decisions. They buy because they want to be right. They sell because they want to stop the pain. They chase because they want to belong. They freeze because they're afraid to be wrong. So the most valuable investing skill isn't finding the perfect trade. It's staying grounded while the market tries to move your emotions like a puppet. Today, I'll give you 5 ways to stay grounded while investing. 5 tools that protect your psychology, your capital, and your long-term optionality. And stay until the end, because I'll give you a rule that has saved more money than any stock tip. The Grounded Investor Checklist. 7 questions you ask before you buy, before you sell, and especially before you panic. Let's begin. Welcome back to the podcast. Today's episode is 5 ways to stay grounded while investing. Quick disclaimer. This is educational content, not financial advice. I'm not your advisor. My goal is to give you a framework that reduces mistakes, because investing is less about brilliance and more about avoiding self-destruction. If you've ever felt FOMO during rallies, regret after buying tops, panic during drawdowns, or paralysis when you should act, then you already know why this episode matters. Markets are uncertain, and uncertainty triggers emotion. Emotion triggers mistakes. So groundedness is not a personality trait, it's a system. Here's the principle. We are fallible. In markets, you will be wrong, sometimes loudly. So the goal isn't to be right all the time. The goal is to stay solvent, flexible, and emotionally stable enough to keep playing. Because compounding only works if you survive. And survival requires groundedness. This is why professionals obsess over position sizing, downside control rules, and process. Not because they're boring. Because they've seen what happens to talented people who lose control of their mind. Here's the roadmap. I'll give you 5 grounded investing tools. Build an anti-fragile portfolio core so you don't panic. Separate signals from noise so you stop reacting to headlines. Use rules for risk so emotions can't hijack sizing. Practice the 2 clocks mindset, short-term price versus long-term value. Run the pre-trade grounding ritual, a checklist that blocks impulse decisions. And throughout, I'll tie it to a Soros-style lens. Fallibility. Expect mistakes. Reflexivity. Emotion changes outcomes. Optionality. Don't get forced. Because when you're forced, you're weak. Later, I'll expose the biggest lie investors tell themselves. I'm investing. I'm not emotional. Most emotional decisions are disguised as logic. I have a thesis. But it's FOMO. I'm managing risk, but it's panic selling. I'm being patient, but it's denial. Grounded investing is knowing the difference. We'll cover that and how to build a process that makes the difference obvious. Let's start with the obvious truth most people ignore. You can't stay grounded with a fragile portfolio. If your portfolio can be destroyed by a normal market drawdown, you will not think rationally. You will react like a human under threat. So groundedness begins with structure. Anti-fragile doesn't mean never down. It means you can survive volatility. You can stay in the game, and you can even benefit from chaos because you're not forced. Here are the components of an anti-fragile investing core. 1. A sleep well allocation. If your portfolio keeps you awake, it is too risky for your psychology. So the first rule is simple. Your baseline allocation must let you sleep. This usually means avoiding leverage you can't control, not concentrating into one idea, keeping enough safe assets cash to prevent forced selling, and being honest about your emotional limits. Professionals respect psychology as a constraint. They don't pretend to be robots. 2. A cash buffer that prevents forced decisions. Cash is not trash when it prevents forced selling. Cash is optionality. When markets drop, fragile investors sell to survive. Grounded investors can hold and sometimes buy. If you want to stay grounded, you must stay unforced. Your buffer is what keeps you unforced. 3. A core that matches your time horizon. This is where people blow up psychologically. They invest long-term money like it's short-term money. They check it every day. They trade it emotionally. They treat the portfolio like entertainment. So here's the rule. Long-term money should be built on long-term instruments and long-term expectations. A calm core typically means diversified exposure, repeatable contributions, and no need to be right this week. You don't win investing by winning 1 month. You win by surviving 10 years. 4. Position sizing that assumes fallibility. This is the Soros rule. Assume you can be wrong. So size positions, so being wrong doesn't destroy you. A grounded investor doesn't need perfect confidence. They need controlled downside. If a single position can ruin you, you're not investing. You're gambling with delayed consequences. 5. The fragility test. Do this today. Ask yourself, if my portfolio drops 20-30%, do I panic? Would I be forced to sell to pay bills? Would my lifestyle be threatened? Would I abandon the plan? If your answer is yes, your portfolio is fragile. And you won't stay grounded because your nervous system will be correct to panic. So before you look for returns, you fix fragility. Mini takeaway. Groundedness isn't a meditation technique. It's portfolio architecture. Build a core that keeps you unforced, and the mind becomes calmer automatically. Now we move to tool number 2. Because even with a strong core, you can still lose your mind if you consume the market incorrectly. Most investors don't lose money because they lack intelligence. They lose money because they drown in noise. The market produces infinite information. News, tweets, opinions, predictions, breaking alerts, sensational narratives, and your brain interprets volume as importance. That's how you get emotional whiplash. So grounded investors do something radical. They reduce inputs, and they raise standards for what counts as signal. 1. Know the difference. Information versus decision-relevant information. Information is anything you can consume. Decision-relevant information is what should change your actions. Most information should not change your actions. If you're a long-term investor, today's drama is usually irrelevant. So ask, does this information change my thesis, my risk, or my time horizon? If not, it's noise. 2. Limit the frequency of observation. Here's a painful truth. The more often you watch prices, the more emotional you become. Not because you're weak, because frequent observation increases the number of perceived losses, even in an uptrend. So grounded investors control screen time like diet. They don't live inside the chart. Practical rule. Long-term portfolio review, weekly or monthly, not 30 times a day. Your brain was not designed for real-time mark-to-market. 3. Choose 3 signal sources and ignore the rest. Grounded investors build a signal stack. For example, 1 macro summary, 1 earnings financial source, if you invest in stocks, 1 risk market structure source. Everything else is entertainment, and entertainment is expensive when it influences your decisions. 4. Use a headline filter. If the headline triggers anger, fear, urgency, certainty, it's probably designed to manipulate attention, not inform your portfolio. So before you react, ask, if this headline disappears tomorrow, would my investment plan change? If not, ignore it. 5. The reflexivity warning. Remember, narratives move crowds, crowds move prices, prices change narratives. That loop is reflexivity. If you consume too much noise, you become part of the crowd, and the crowd tends to buy late and sell late. Grounded investors aim to step outside the loop, not by predicting perfectly, but by refusing to be emotionally traded. If you want to stay grounded while investing, you need one thing more than intelligence. You need rules that execute when your emotions cannot. Because the market's job is to test your psychology. It will offer you 2 forms of temptation: greed in rallies, fear in drawdowns. And when you're emotional, your brain becomes an unreliable narrator. So tool number 3 is about removing decision-making from the emotional moment. Tool number 4 is about changing your relationship with time, so price volatility stops feeling like a personal attack. Let's go. A grounded investor treats risk like oxygen. You don't notice it when you have enough. But if you lose it, everything else becomes irrelevant. So here are the risk rules that keep professionals grounded. If one trade can define your self-worth, you are already unstable. Grounded investing requires emotional separation. You can be wrong without being a failure. The market can disagree without insulting you. This is fallibility applied to psychology. So, you avoid hero positions. You avoid concentrated bets that require you to be right. Most people size positions like this. How much can I make? Professionals size like this. How much can I lose if I'm wrong? So your sizing should be linked to worst-case drawdown time horizon and your ability to hold without panic. Practical shortcut. If a position dropping 20 or 30% would cause you to abandon the plan, The size is too large. Ruin is not losing money. Ruin is losing the ability to continue. So you define a hard line. No leverage that can margin call you. No single position that can wipe you out. No concentration that makes you desperate. The grounded investor's first priority is survival. Because compounding only works if you remain solvent. Guessing tops and bottoms is a stress addiction. Rebalancing is a system. So you create a simple rule. Rebalance quarterly or semi-annually, or rebalance when allocations drift beyond a threshold. This automatically forces you to trim what ran up, add to what fell, without relying on emotion. You're not predicting, you're managing. Here's a rule that calms people immediately. You don't make portfolio changes every day. You set a decision day, once a week or once a month. All impulses go into a note. Consider selling X, consider adding Y. Then on decision day you evaluate calmly. This prevents panic decisions, because most panic decisions are temporary emotions that feel permanent. You prepare scripts like a pilot prepares checklists. Examples. If the market drops 10%, then I do nothing except review my risk. If it drops 20%, then I rebalance according to plan. If my thesis breaks, then I exit in a structured way. If I feel FOMO, then I wait 48 hours before buying. These scripts create groundedness because they remove improvisation. Rules don't eliminate emotion. They prevent emotion from controlling actions. Now we go to tool number 4, the 2 clocks mindset. Because even with rules, you can still feel unstable if you interpret the market with the wrong time lens. To stay grounded, you must understand time. The market is a machine with multiple clocks running at once. Most investors only watch one clock, the price clock. The price clock ticks every second. Up, down, panic, relief headlines, reactions. But there is another clock, the value clock, or the fundamental clock. This clock ticks slowly. Earnings, cash flows, productivity, inflation, regimes, demographics, innovation, policy cycles. Grounded investors live on the value clock. Speculators live on the price clock. Both can make money. But if you invest long-term while living mentally on the price clock, you will suffer. Because you will experience long-term investing as daily emotional trauma. How to use the 2 clocks? When you feel triggered by volatility, ask, which clock am I watching right now? Is my strategy aligned with this clock? If you're a long-term investor, your strategy must match the value clock. You check less, you react slower, you focus on process, you judge performance over years, not days. If you're trading short-term, fine. But then you must have strict risk controls because the price clock is violent. The problem is not trading. The problem is mixing clocks. Long-term thesis, short-term emotional behavior. That's how people destroy themselves. The meaning upgrade. Here's a grounded reframe. A price move is not a verdict on your intelligence. It's a fluctuation in a complex adaptive system. If you interpret every red day as I'm wrong, you'll overtrade. If you interpret every green day as I'm a genius, you'll oversize. So groundedness means you stop letting the price clock define your identity. In part 4, final, we finish with tool number 5, the pre-trade grounding ritual. A 2 to 5 minute checklist you run before you buy or sell. Then I'll give you the grounded investor checklist. 7 questions that prevent impulse decisions, FOMO, panic selling, and thesis drift. This is the part that turns knowledge into behavior. Now we finish with the most practical tool in this entire episode, a ritual. Because you don't stay grounded by having good intentions. You stay grounded by interrupting impulses before they become decisions. Most investing mistakes don't happen because people lack information. They happen because people act while emotionally activated. FOMO, fear, anger, revenge trading. I need to get back to even. This time is different. So tool number 5 is a pre-commitment device, a short ritual that forces your rational mind to re-enter the room. Then I'll give you the grounded investor checklist, the 7 questions that block the most common investor self-destruction patterns. Let's go. You run this ritual before every buy-sell, especially when you feel urgency. Step 1. Name the emotion 10 seconds. Say it out loud. I feel urgency. I feel fear. I feel FOMO. I feel regret. This matters because unspoken emotion becomes action. Spoken emotion becomes data. Step 2. Pause the trigger, 60 seconds. Do one of these. Stand up, take 5 slow breaths, drink water, walk for 1 minute, step away from the screen. The point is not spiritual, it's biological. You're lowering arousal so you can think. Step 3. Identify the clock, 15 seconds. Ask, am I acting on the price clock or the value clock? If you're a long-term investor and you're acting on the price clock, you are probably making a mistake. Step 4. State the decision in one sentence. Example, I want to buy because I think it will go up. I want to sell because I can't handle the drawdown. I want to buy because my thesis is intact and I'm rebalancing. Make it explicit. If the reason is vague, it's emotional. Step 5. Run the checklist, 2 minutes. This is the real filter. If you fail the checklist, you don't trade today. You wait 24 to 48 hours. That's how grounded investors protect themselves. Here are the 7 questions. Write them down. This is your firewall. 1. What is my thesis and what would disprove it? If you can't explain the thesis clearly, you don't have one. And if you can't name what would disprove it, you're not investing, you're hoping. 2. What is my time horizon for this decision? Days, months, years. If you don't define the horizon, the market will define it for you by making you emotional. What is my downside? And can I tolerate it? Not, can I tolerate it in theory? Can you tolerate it emotionally without panic selling? If not, size down. 4. Am I being forced by my own structure? Forced means you need liquidity soon, you used leverage, you overconcentrated, you have no buffer. If you're forced, your decision quality collapses. Grounded investors engineer a life where they're not forced. 5. Is this decision aligned with my rules? If you have rules, follow them. If you don't have rules, don't pretend you're investing. Create rules first. 6. Would I make the same decision if I couldn't look at the price for 30 days? This is a powerful test. If the answer is no, your decision is likely reacting to short-term noise. 7. What is the simplest alternative action? Before you trade, ask. Do nothing, rebalance. Instead of chase, buy smaller, wait 48 hours. Add via scheduled plan, DCA. Reduce noise inputs. Often, the best action is the least exciting one. Grounded investors don't need excitement. They need compounding. Let's summarize the entire episode in one clean set of principles. 1. Build an anti-fragile core so you can stay calm and avoid forced selling. 2. Separate signal from noise. Less input, higher standards. Stop letting headlines trade your emotions. 3. Use rules for risk, size from downside, not upside. Pre-commit your behavior. 4. 2 clocks mindset. Price clock is loud, value clock is slow. Choose the clock that matches your strategy. 5. Pre-trade grounding ritual. Interrupt impulse with structure. Ask the 7 questions before you act. That's how you stay grounded. Let me close with the most important idea. Markets don't reward confidence, they reward correct positioning, while admitting you can be wrong. Fallibility is not weakness, it's realism. So grounded investing means you size, so wrongness doesn't destroy you, you build a core that prevents panic, you reduce noise, you follow rules, you respect time horizons, and you keep optionality. Because the investor who survives the storms is the investor who compounds. And compounding is the only magic that's real. If you found this helpful, here's your assignment. Before your next buy or sell, run the pre-trade grounding ritual. Answer the 7 questions. If you can't answer them, you don't trade. Simple.